The Nasdaq just had a week that should make every tech-heavy portfolio manager uncomfortable, not because it fell, but because of what fell and what didn't. While the Nasdaq dropped 3.32%, the broader S&P 500 only gave back 1.59%. That 2-point spread is the entire story. It means this wasn't a market sell-off. It was a surgical rotation. The VIX jumped 6.54 points in 5 sessions. Microsoft touched a one-year low. OpenAI quietly deferred a major model rollout. So here's the question you need to answer before the open on Monday. Are you watching a temporary pullback in the best assets on Earth? Or are you watching the first leg of something that reprices AI infrastructure for the next 12 months? Let's start with the number that most people skipped over. The Nasdaq fell 3.32% this week. The S&P 500 fell 1.59%. That 1.73 percentage point gap between those two indices in a single week is historically significant. When you see that kind of spread, large cap tech dramatically underperforming the broader market, it is almost never random. It reflects active portfolio decisions at scale. Institutions don't accidentally sell one sector by 1.73 points more than another. They choose to. Layered on top of that, the VIX rose 6.54 points. For context, a 6-point weekly move in the VIX doesn't happen in orderly sell-offs. It happens when portfolio managers are buying protection in size, puts, collars, volatility exposure, because they're uncertain about the shape of the next move, not just the direction. Now here's where it gets specific. Microsoft, the second largest company in the S&P 500 by market cap, hit a one-year low this week on concerns about its AI capital expenditure trajectory. The narrative being priced in is that the return on AI infrastructure spending is taking longer to materialize than the market originally modeled. That's a multiple compression story, not an earnings collapse story yet. But multiple compression in a rising rate environment, which we'll get to in a moment, compounds painfully fast. The actionable read here is this. A Nasdaq underperforming the S&P by that margin, with VIX elevated and the largest AI infrastructure spender at a 52-week low, is not a dip-buying signal. It is a signal to audit your concentration. Know exactly how much of your portfolio's beta is tied to AI CapEx narratives before Monday's open. Here's where most of the commentary this week got it wrong. They looked at the tech sell-off and concluded AI trade is unwinding. That's a lazy read. The data tells a more nuanced story, and nuance is where positioning alpha lives. While Microsoft was getting repriced lower on AI spending concerns, Intel was up 6% on the week. Micron is sitting on an earnings catalyst that the options market is pricing with significant implied volatility. The Philadelphia Semiconductor Index, the SOX, did not move in lockstep with megacap software. That bifurcation is the signal. What's actually happening is a rotation within tech, not a rotation out of tech. Capital is moving away from the companies that spend on AI infrastructure and toward the companies that supply it. This is a classic late-cycle dynamic in any technology build-out. In the early innings, you buy the picks and shovels, the infrastructure enablers. In the mid-cycle, you buy the platform companies that monetize on top of that infrastructure. When the market starts questioning whether platform monetization is arriving fast enough, capital flows back down the stack toward the hardware and memory layer, because those companies' revenues are tied to volume shipped, not to ROI on AI features. OpenAI, deferring the GPT 5.6 rollout while the U.S. government seeks early access to frontier models, adds another layer here. Regulatory friction on frontier model deployment compresses near-term software revenue visibility. But it doesn't stop memory chips from shipping. It doesn't stop data center builds from consuming DRAM. The actionable insight, if you are rotating, the question is not tech versus no tech. The question is where in the stack you want to be. Semiconductor supply chain, specifically memory, interconnects, and power management, is absorbing the rotation, not losing from it. This is not financial advice, but the SOX to Nasdaq spread this week is worth pulling up on your own charting platform before you make any moves. None of the sector dynamics we just discussed exist in a vacuum. They're being amplified by a macro backdrop that the market spent most of the first half of 26 trying to wish away, and this week had to confront directly. Fed Chair Warsh's recent remarks on inflation expectations were notably more hawkish in tone than what the market had priced in heading into the week. Warsh has consistently signaled that the Fed is watching inflation expectations with more urgency than the headline rate itself. That matters because of what the AP reported this week. The Fed's preferred inflation gauge just hit a 3-year high. 3 years. That's not a transitory blip you can talk around. That's a structural re-anchoring of where price levels are settling. For technology stocks specifically, this creates what I'd call a rate trap. High multiple growth stocks are priced on discounted future cash flows. When the discount rate goes up, because inflation expectations force the Fed to hold rates higher for longer, the present value of those future cash flows compresses. This is pure mathematics, not sentiment. A stock trading at 35 times forward earnings with a 10-year Treasury yield moving from 4.2% to 4.7% doesn't just feel worse, it is worth less by a calculable amount. Here's what separates the hedgers from the panickers in the current VIX environment. Panic selling looks like indiscriminate liquidation across all tech names. Hedging looks like adding put spreads on megacap software while rotating into shorter duration assets within the same sector. Think chip stocks with near-term earnings catalysts, like Micron, where the cash flow realization is quarters away, not years. The positioning read, going into Monday. The macro ceiling is real. The sector rotation is real. And the bifurcation within semiconductors is the most actionable divergence in the market right now. Understand which side of that trade your current holdings are on. The spread between hedgers and panickers is measured in basis points this week. By next quarter, it may be measured in percentage points. We opened this week asking whether the Nasdaq's 3.32% drop was a dip or a regime change. The answer is, it's neither. It's a rotation. Within tech, down the stack, toward hardware, and away from AI platform multiples that need lower rates and faster monetization to justify their prices. The macro ceiling from Warsh and the inflation print makes that ceiling hard to break near term. The question we're going to answer next: which specific semiconductor subsectors are structurally positioned to absorb this rotation, and which ones are just riding momentum? Subscribe so you don't miss it.